Hey traders, in this video I am going to explain the concept of support and resistance. So stay tuned to learn more. Don't forget to subscribe to my channel for more videos about Forex trading.
What are support and resistance levels in Forex trading? Support and resistance are specific price areas or price levels which either support prices on declines in uptrends, or which resist prices on rallies in downtrends, in an uptrend. Short-term and day traders will attempt to buy at support or at levels of support. In a downtrend, short-term and day traders will attempt to sell at resistance levels or in resistance areas. If support and resistance levels cannot be determined, then you cannot define concise levels in which to establish entry or exit positions in your specific trade. It is of utmost importance for traders to develop effective strategies and methodologies for calculating support and resistance levels. These levels can be determined with the use of various trading tools like point and figure charts, Fibonacci numbers and Gann angles. Day traders are in a definite advantage when it comes to the use of support and resistance levels, inasmuch that the trading normally ends when the trading day is over, and if a bad trade or decision was made based on support or resistance levels, it will not be repeated in the next trading day. Determining support and resistance levels are somewhat different for the day trader than the position trader. This is because support and resistance levels for the day trader must be closer to the current market price than they are for the long-term or position trader. Markets can only drop so far in one day, and consequently the determination of support and resistance levels by the day trader must be realistic in terms of what can be expected. However, this does mean that day traders must be willing to use realistic technical support and resistance levels in order to establish their positions.
Support and resistance has long been a staple in trading indicators. Support and resistance is a simple concept that has its roots in the supply and demand theory. When looking at a chart, you see price action that appears to be random, but by adding support and resistance theory to the equation, you will see that the price movements are not always random. I first noticed this before I started trading. I used to watch the stock ticker on TV. And over time I noticed that at certain price levels on the Dow Jones Industrial Average would seem to have difficulty breaking through some price levels. It was more obvious when the price tried to move through round numbers. As prices go up, there comes a point when the traders feel that the price is too high and the buyers will slow. This is called resistance. Generally, for a price area to be called resistance, you will have to have 3 or more hits on or very near the same price. The same rules apply to support, but this term describes the failure of prices to continue going down. Once a price goes down to a point, the prices is viewed as being a good deal. Much the same way a store puts things on sale. When the sale price in effect, there are usually more buyers willing to purchase. The markets work the same way. The more hits on a price level, the stronger that support or resistance is believed to be. Many times there may be no good explanation for a support or resistance level other than people believe in it. Often this is enough to cause the market to stall or reverse direction. Perception is often the motivation behind the market's price movements. I have saw prices move drastically because of rumors. On the other hand, I have seen very little movement in prices following what you would think to be an important announcement. Support and